Hey there, everyone. Ryan Schul at Straight Data Science. This is my data science and machine learning channel. So I have an interesting topic today. I'm going to show you how to value an asset that has no active market value. Okay, so market value would be like the price of Microsoft or Amazon or Tesla stock. There's an active market for it, for these assets, and you know exactly what the fair market price is, right? It's whatever it's trading at on whatever exchange it's at, and it can be traded on different exchanges around the world. Some are international at that point in time, right? So everybody knows what the price is. But what if you have an illiquid market or a security that doesn't trade very often, or there's not too many people that are interested in a specific asset, but it still has a value? How can you determine the value for that? So let me show you a few different techniques to do that. We can use something called discounted cash flow. This basically estimates the value of an asset based on expected future cash flows discounted back to the present value. So in the finance world, we always look at the time value of money. A dollar today is worth more than a dollar 1 year from now for a couple primary reasons. Number one, you can take that dollar and invest it. It's not big money by any means. A dollar is not a lot, but you can invest a dollar, and if you have capital gains, you can grow your money, right? And you'll have more than you will have in 1 year. And the dollar today is also worth more than the dollar that you receive 1 year from now because of inflation, okay? So a dollar 1 year from now is going to be worth less just because of the eroding purchase price of inflation as things get more and more expensive over time. So we can also look at internal rate of return. This is the internal return that an investment can generate. Again, we look at this on a relative basis, so discount everything back to the present value, or look at the time-adjusted value of all these things, so we can compare apples to apples, right? We always want to look at something at the present time. We can look at net present value. So again, present value, discounted cash flow, takes everything discounted back to today. Net present value is basically showing how much value the investment adds beyond its cost. And we can look at comparing multiples, or using different financial averages like the PE ratio. I'll show you a few techniques for valuation. If you like this type of stuff, I have a whole bunch, not a whole bunch, but a few videos on my channel about different types of financial metrics and financial ratios and what they all mean, okay? So that is another technique we can use. And basically just valuing an asset that's very illiquid, which means it doesn't trade very often, or maybe not at all, but it can be traded, and you know there is some intrinsic value or some inherent value for this asset. We can try to determine what that is, okay? And these are some different techniques that we can use to achieve that goal. So let's say we have cash flows. In this scenario, I have these separate cash flows going for year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I have 10 years, and the discount rate is 12%. So basically, this is the financing rate, or this is the bank. This is the rate that we would have to pay the bank interest on this loan to get everything discounted, again, back to the present value. So we have EBITDA, which is earnings before interest, tax, depreciation, and amortization. And we have a multiple, EBITDA multiple of 8. Net income, and this assumption is $40,000, okay? And the PE ratio, for these bigger numbers too, you can use an underscore, and it's like the same thing, because you can't have commas in here, right? If you try to put in a comma, it makes it easier to read. Whoops, that's apostrophe. But the machine is not going to know what a comma is. Whoops, that's a back arrow. All right, it's going to throw an error. But instead of a comma, we can use an underscore to make these things a little bit easier to read for people, and the computer will just ignore that. So we have DCF valuation is $162,021. So where does that come from? It's these 10 cash flows for the next 10 years. You're basically making an investment in some type of asset. It could be anything. It could be a piece of hardware. It could be a small business that is rented out by a professional service firm, a doctor, a group of small doctors, a group of small lawyers rent your office space, right? That could be generating cash flows for you. And the cost to buy the space, to go out into the market and buy the space, is going to take whatever amount you invest in it, discounted at 12%. That's what you're paying for the loan, right? Book value, again, is 180. We can make that a little bit easier to read for these bigger numbers. Price to book ratio is 1.2. Then we get the calculations are done here. So valuing the DCF is the net present value of the discount rate, the initial investment, and the list of cash flows. You can tell this is a list because it has square brackets around it. Value the PE and the price to book and the EBITDA. So we get these values down here. And then the blended value would be the mean of all of these over here. Okay, so we have the DCF valuation. So all these cash flows from 50,000 to 850,000, different frequencies or different amounts over the next 10 years. This asset to you is worth 162,000. So that's a good example, actually. If you want to go out and buy like a small retail store or something and rent it out to a professional service team, again, a small group of doctors or a small group of lawyers, and you can estimate that you can generate these cash flows and you pay the bank 12% for the financing for that asset to you is worth 162,000. So you can actually make a profit if you know you can get this asset for 150,000, then you're going to have a positive DCF, a positive IRR, the internal rate of return is going to be positive, and it's actually worth more than the market price, right? Now, if you overpay for that, then some of these numbers are going to go inverted and it's probably not a good investment, right? And then you'd have to have a lease and a contract. But if the tenants that you rent the space to leave after 5 years, then you're going to have to scramble and find new tenants. So it's probably be a clause in a contract where they have to pay a penalty or something. But anyways, the asset today with these cash flows for the next 10 years at 12%, cost of borrowing, that's the cost of doing business, is worth 162,000. The EBITDA is 560,000. The price to earnings is the price that you pay to earn this amount of money is 400,000. Price to book is 216, and the blended, which is average of all these right here, price to book, PE, earnings value, and DCF is all 334,000. So basically, the rule of thumb is if DCF is positive, I mean, in theory, even if it's positive $1, you could do the deal. Now, I wouldn't get a loan for 10 years at 12% and get these cash flows just to make a buck. But in theory, if the DCF is positive, at least $1, then it makes sense to do the deal. You want the DCF to be higher. Higher is better. That's more money for you. Anything is positive, you can move forward with it. Anything is negative, you don't touch it. Okay, that's not a good investment. So now we just assign a value to a piece of property when there was none before, right? So I think that's pretty phenomenal that we can do that. We can go ahead and determine the intrinsic inherent value of something that's generating wealth for us. This is generating wealth for the next 10 years. So it's pretty consistent, very persistent, and it's a good investment because we're making 162,000 by not really doing a whole lot, just collecting rents. And the asset can be anything, right? It can be any kind of tangible property that has some kind of wealth generating mechanism for yourself. It could even be rare art, a piece of art that you hang on your wall. There's no market for that probably, but potentially, you could buy the piece of art for, I don't know what, $500,000, maybe sell it for $1 million. So that's generating revenue for you. It's not discounted cash flow revenue, but it's still an investment, right? If you pay a couple million for a piece of art, you sell it for $5 million, you have a capital gain on the art, right? You still made the $3 million profit and you can enjoy the art hanging on your wall for as long as you have it. So that's a good investment, right? So just the whole concept here and the whole theory is we're trying to determine what something potentially could be worth. That's an asset that we can't just go out into the market and say, okay, I know what this is worth. I can assume, or I can calculate what this is worth. It takes a little more effort and a little bit more legwork to determine these valuations, but it's not that hard, guys. It's not that hard. So let's look at another example down here. Now we have more of a scenario analysis. The scenario is the interest rate that we are charged on the loan is going to change slightly over time. Okay, so the IRR is going to go from 8% to 10% to 12%, and we just want to look at different potential NPVs as we pay different interest rates for the loan. Now I'm looking at this. I don't have to print out the IRR each time. That was unnecessary because that's not going to change. But that's fine. I'll just leave it in there. But you can see as the interest rate on the loan is lower, the value to you of that piece of property, because you're paying a smaller mortgage, is more, right? The value of that property is more as you're paying less for the loan. So at 8%, that same asset is worth 236K. If you have to pay a higher interest rate, this is the discount rate, it's worth 196K. If you have to pay 12%, it's worth 162,021. That's how we got this number over here, remember? Because we said the discount rate is 12%. So we're doing the same type of analysis. The only difference is we're looping through 3 scenarios so quickly and easily we can see how much this asset potentially is worth at different interest rates. That is what we'll have to pay the bank for the loan for this money, okay? So that's a scenario analysis. A Monte Carlo simulation is when we run a whole bunch of different scenarios. In this case, we do 1,000 different scenarios. Here we did 3, okay? So this is 8, 10, and 12. Here we do 1,000 different scenarios. So the computer runs the analysis pretty quick and pretty fast, so we hardly even notice it. Then we can plot the results below. So now instead of looking at just 3 scenarios, we see 1,000 different potential scenarios with a whole bunch of different interest rates. The frequency of those counts of the outcome, and then the associated NPV. So if the interest rate is very low, remember, NPV is going to be high. If the interest rate is high, the NPV is going to be low. We saw that over here, right? So low interest rate, high NPV, high interest rate, low NPV, right? So we see the different scenarios. And the lowest NPV we get in this case with 1,000 scenarios is 130K, and the highest we get, so this would be the best case scenario, we just get 1. More likely it would probably be like around here, but this would actually be the most likely, right? It's kind of a normal distribution, bell-shaped curve. We know after 1,000 scenarios, the property is probably worth about 160K to 170K. And we've assumed a whole bunch of different potential NPV, discount rates, right, for this scenario. So the property, if we can buy this between 160K to 170K, that would be the NPV to us. So we're making 170K in the next 10 years. That's the total amount of the value of this asset. So we should go ahead and invest in the asset. That's a green light. That's go for that, okay? So again, anything over positive NPV, we do the transaction, and higher is better, okay? So what else? I'll just summarize the last thing. The last thing I have in my notes, when an asset has no observable market value, such as private equity, distressed assets, early stage startups, IP portfolios, or infrastructure projects, even building out infrastructure, even if you have to build a dam, if you have to build a bridge or a highway, this is a great way to determine the value of that asset, whatever it is that you're financing, right? This is a different financing techniques, and how do we manage it efficiently and responsible? That's what NPV analysis is for, and IRR. And, like I said, maybe rare artwork. Again, there's no cash flows for the art, so that's kind of like a little bit different scenario. But again, there's ways to value the artwork too. So basically, the real world implications here are real options value, cost-based valuation, right? We're using judgment, we're using mathematics, we're using information to make an intelligent, informed decision, expert judgment, income capitalization, machine learning, model valuation, what else? Bayesian valuation, and belief updating. We really didn't get too much into that topic today, but I have several videos on my channel about Bayesian analysis, so you can check that out. Scenario analysis, we certainly did that. Monte Carlo simulation, we did that. Shadow pricing and infrastructure valuation models, right? Again, if you have to build a dam or a some type of energy generating asset, whether it's dirty energy or renewable energy or a bridge or a highway, these are techniques that you can use to value the project and make sure it has positive NPV, or you don't engage in a project, right? Or you have to renegotiate the cost or something. It has to be positive NPV, or you don't back it, because that's a bad investment and you're guaranteed to lose money. So hopefully that's it, guys. Hopefully I covered the topic and gave this its full attention here. I think these things are pretty interesting, and I like to just drop knowledge and help people to learn different concepts and different techniques. I'm going to keep this one relatively short. I'm going to wrap it up in just a bit. And I will put all this code online so you can download it and run it in your own Jupyter Notebook environment and do the analysis for yourself and see how everything turns out. And then by all means, mess around with the numbers over here. Add a couple more cash flows. Make it 12 years, make it 20 years. Check out different interest rates, right? And change the interest rates down here. That's what the scenario analysis is for. And add more simulations here. I can add one more. I can go from 10,000 to 100,000, rerun this, and see what the outcome is going to be. Okay, somewhat similar as before. We just have more outcomes now. Now we have, instead of 1,000 different scenarios, we have 10,000. So again, the most frequent count is about 160 to 170. A little bit lower NPV would be 155. And the probability of this happening is a little bit lower, right? But we can also assign like total probabilities. What's the most likely 90%? I didn't add that into here. Maybe I could. Maybe I'll just modify the code a little bit before I actually post it. But that's pretty much it. I think we covered the topic sufficiently. So I'll make a small modification to the code. I'll post everything later today. You'll have everything you need. Go ahead and copy it, paste it, modify it, and by all means, learn as much as you can from these scenarios. Okay. Thank you so much for your time. I'm going to wrap it up, and I will see you in the next video. Bye.